Imagine trusting someone with your entire life's work, your retirement, your children's future, your most cherished dreams. Now imagine it all vanishing, not in a market crash, but because it was never real, never invested. Just a breathtaking lie orchestrated by a man who was once a titan of Wall Street. This is the story of Bernard Madoff, the man who built a $64.8 billion phantom empire, and how he stole not just money, but hope itself from thousands. For decades, Bernie Madoff was a name synonymous with success and trust on Wall Street. He founded Bernard L. Madoff Investment Securities LLC in 1960, building a firm that became incredibly influential. He was a pioneer in electronic trading, even serving as chairman of the NASDAQ stock market. To the world, Madoff was a visionary, a savvy investor who delivered consistently high returns, year after year, no matter what the market was doing. He wasn't flashy. He was understated, almost exclusive. His firm became a magnet for the wealthy, for celebrities, for charities, and for ordinary people desperate for a secure future. They believed in Bernie. They believed in his promises of 10 to 15% returns, steady and reliable, a safe harbor in the unpredictable seas of finance. But what they didn't know, what no one knew, was that the entire empire was built on a foundation of sand, hiding a secret that would become the largest financial fraud in history. Madoff cultivated an aura of exclusivity. You didn't just invest with Bernie, you were invited. This created a powerful psychological draw, making people feel privileged to be part of his inner circle. His reputation grew, not through aggressive advertising, but through word of mouth among the elite. Investors saw their monthly statements arrive, showing consistent, incredible gains, 10 to 15% annually, even when the market tanked. This wasn't just good, it was too good to be true. Yet, Madoff had an answer for everything. He claimed to use a complex split-strike conversion option strategy, a sophisticated method that supposedly insulated his investments from market volatility. It sounded plausible enough to those without deep financial knowledge. And for those with it, Madoff's track record spoke for itself. He was a trusted figure, and trust, it turned out, was his most potent weapon. The scheme, believed to have started as early as the 1970s, quietly expanded, fueled by an endless stream of new clients drawn to the promise of effortless wealth and unwavering stability. So, how did Bernie Madoff achieve these miraculous returns? The shocking truth is he didn't. There was no secret trading strategy. There were no investments. It was all an elaborate lie, a classic Ponzi scheme, the financial equivalent of robbing Peter to pay Paul. Here's how it worked. When new investors gave Madoff their money, he didn't put it into the market. He simply deposited it into a single bank account. Then, when existing investors wanted to withdraw their profits or their principal, Madoff just paid them with money he'd received from newer investors. Think of it like a never-ending chain letter or a house of cards. As long as there was a continuous flow of new money coming in, the illusion could be maintained. To keep up appearances, his firm generated incredibly detailed but completely fabricated account statements and trading confirmations. These documents looked legitimate, showing trades that never happened, profits that never existed. It was a phantom portfolio conjured from thin air, designed to deceive, and it worked for decades. But even the most meticulously crafted lies eventually show cracks. For years, the financial world whispered about Madoff's impossible consistency. One man, financial analyst Harry Markopolos, didn't just whisper, he screamed. From 1999 to 2008, Markopolos repeatedly tried to warn the U.S. Securities and Exchange Commission, the very body tasked with protecting investors. He submitted detailed analyses, demonstrating mathematically why Madoff's returns were statistically impossible and almost certainly fraudulent. He showed that Madoff's claimed strategy couldn't generate those returns, and that the numbers simply didn't add up. The SEC even investigated Madoff's firm as early as 1992, and again after Markopolos' persistent warnings. Yet, time and again, they failed to uncover the truth. They interviewed Madoff, accepted his explanations, and somehow missed the glaring red flags. The very system designed to prevent such a catastrophe was either outsmarted or simply unwilling to believe that such a respected figure could be a criminal. The house of cards, however, could not stand forever. The year was 2008, and the global financial crisis was gripping the world. Markets were crashing, and panic was setting in. Investors, desperate for cash, began to demand their money back from Madoff. A surge of redemption requests, totaling an estimated $7 billion, flooded his firm. But Madoff had no money to give. The continuous influx of new funds had dried up, and there were no actual investments to liquidate. The well was empty. On December 9, 2008, Madoff finally confessed the unspeakable truth to his brother and his two sons, Mark and Andrew. He told them his entire business was one big lie, a giant Ponzi scheme. His sons, who worked in the legitimate trading section of the firm and claimed to have no knowledge of the fraud, were stunned. The very next day, on December 10th, they reported their own father to federal authorities. On December 11th, 2008, Bernard Madoff, the once unassailable titan of finance, was arrested and charged with securities fraud. The secret of $64.8 billion was finally out. The revelation sent shockwaves across the globe. The scale of the deception was almost unimaginable. While the total fraudulent value was nearly $65 billion, the actual direct losses to investors amounted to a staggering $18 billion. The victims were incredibly diverse: wealthy individuals and celebrities, major foundations, but also small charities, pension funds, and ordinary people who had entrusted Madoff with their life savings. Many lost everything. Retirement funds vanished overnight. Charities dedicated to helping others were themselves wiped out. The emotional toll was immense, leading to profound distress and, tragically, at least 4 suicides linked to the scandal, including Madoff's own elder son, Mark, who took his life exactly 2 years after his father's arrest. His younger son, Andrew, died of cancer a few years later. On March 12, 2009, Madoff pleaded guilty to 11 federal felonies, including securities fraud and money laundering, acknowledging he had never invested a dime. On June 29, 2009, he was sentenced to 150 years in prison, where he died in 2021 at age 82. The court-appointed trustee, Irving Picard, has worked tirelessly, recovering an impressive $13 billion by December 2018, but for many, the damage was irreparable. Their dreams, their trust, their futures, all stolen by one man's greed. Bernie Madoff's story is a chilling reminder of how easily ambition can curdle into deception and how devastating the betrayal of trust can be. It's a testament to the seductive power of promises that seem too good to be true and the catastrophic failures of oversight when those promises go unchecked. His empire wasn't built on financial wizardry, but on the simple, dangerous act of exploiting human desire for security and wealth. The Madoff scandal exposed vulnerabilities not just in the financial system, but in human nature itself. It left behind a trail of ruined lives, shattered institutions, and an enduring question: how many other wolves in sheep's clothing still lurk in the shadows, waiting to steal a lifetime of dreams? The Collapse Files will keep digging, because understanding these stories is our best defense against the next one. Don't let yourself be next.